Today, I'm going to show you how to transfer money from a credit card to a bank account. And to make this easy, we're going to use our guy, Tim. This is Tim. Tim has a credit card. Tim also has a checking account. And today, Tim wants to move money from his credit card into his bank account. Sounds simple, right? But here's the hard truth. This is not free money. Let me say that again. This is not free money. When Tim moves money from a credit card to a bank account, he is borrowing money. And most of the time, borrowing this way can cost more than a normal credit card purchase. So in this video, I'll show you the main ways Tim can do it, what fees Tim needs to watch out for, and when Tim should not do it at all. And just a quick note, this video is for education only. I'm not your financial advisor. Before you move money, check your own credit card terms. With that being said, let's get straight into it. First, what does it mean to transfer money from a credit card to a bank account? It means Tim is taking part of his credit card limit and turning it into cash. So instead of using his card to buy something at a store, Tim wants that money inside his checking account. Maybe Tim has rent due. Maybe Tim needs to fix his car. Maybe Tim has a bill that does not take credit cards. That happens. But the problem is this: fast money is often expensive money. So Tim needs to know the cost before he moves the money. There are 4 common ways to do this. Number 1, ATM cash advance. Number 2, bank branch cash advance. Number 3, cash advance check. Number 4, money transfer app or service. Let's start with method number 1, an ATM cash advance. This is when Tim uses his credit card at an ATM. It works kind of like a debit card, but it is not the same thing. Tim puts in his credit card. Tim enters his PIN. Tim chooses cash advance. Tim then takes out the cash. Then Tim deposits that cash into his bank account. Now, that sounds easy, but easy does not mean cheap. With a cash advance, Tim may pay a cash advance fee. The ATM may also charge him a fee as well, and the credit card interest may start right away. And that last part really matters. With a normal credit card purchase, Tim may get a grace period. That means if Tim pays his full bill on time, he may not pay interest. But with many cash advances, there may be no grace period. Then interest can start the same day. So if Tim takes out $500, he may not just owe $500. He may owe $500 plus a cash advance fee, plus an ATM fee, plus interest. That is why Tim needs a plan before he touches the ATM. Here's what Tim should do first. Step 1, check if his card allows cash advances. Step 2, check his cash advance limit. This is very important. Tim may have a $5,000 credit limit, but that does not mean he can take $5,000 out in cash. His cash advance limit may be lower. Step 3, check the fee. Step 4, check the interest rate. Step 5, check when interest starts. Then and only then, Tim can decide if it makes sense. Now, method number 2 is going to a bank branch. This is close to the ATM method. Tim goes to a bank, Tim brings his credit card, Tim brings his photo ID. Tim asks for a cash advance. The bank may give him cash. Then Tim can deposit that cash into his bank account. This can help if Tim doesn't have a PIN. It can also help if the ATM limit is too low. But the same warning still applies. This can still count as a cash advance. That means fees. That means higher interest. That means interest may start right away. So before Tim goes to the bank, he should call his credit card company and ask 3 questions. Question 1, what is my cash advance limit? Question 2, what is my cash advance fee? And question number 3, when does interest start? That one phone call can save Tim money. Most people skip that call and then they get mad when the bill shows up. Do not be most people. Now let's move to method number 3, which is a cash advance check. Sometimes credit card companies send checks in the mail. These may be called convenience checks. Tim can write the check to himself, then he can deposit it into his bank account. Sounds simple, but Tim needs to slow down. These checks are not normal checks. They are linked to his credit card. Some of these checks may count as cash advances. Some may count as balance transfers. Some may have a low rate for a short time period. Some may have a big fee attached. Tim cannot guess. He needs to read the terms. He should look for words like cash advance balance transfer, transaction fee, intro APR, regular APR, and the due date. If Tim does not know what the terms mean, he should call the card company because guessing with borrowed money is very expensive. Now, let's talk about method number 4, money transfer apps and services. Some people use apps or money transfer services to send money with a credit card. This could be PayPal, Venmo, Western Union, MoneyGram, or another service. But this is where Tim needs to be very careful. The app may charge a credit card fee. Then Tim's credit card company may also treat the payment like a cash advance. So Tim could get hit twice. One fee from the app, another cost from the credit card, then interest on top. That is a bad trade if Tim is not paying attention. Also, Tim should not play games with these apps. He should not make fake sales. He should not send money through fake accounts. He should not use a friend just to move money around. That can break the app rules. That can also freeze accounts. In worst case scenario, it can create fraud problems. And now Tim has a bigger problem than the one he started with. So if Tim uses an app, he needs to check the fee first. Then he needs to ask his credit card company if the payment counts as a cash advance. That is the boring step, but boring saves money. Now, let's do a very simple example. Tim needs $1,000. He takes $1,000 cash advance from his credit card. Let's say the card charges a 5% cash advance fee. That fee is $50. So Tim may owe $1,050 right away. Then interest starts. If the interest rate is high, the balance grows every day. So Tim did not really borrow $1,000. He borrowed $1,000 and bought himself fees and interest. That is the real cost. On day 1, Tim feels relief. On day 30, Tim feels the bill. That is why fast cash can become slow pain. Now, when should Tim use this? Tim should only use a credit card to bank account transfer when 3 things are true. 1, Tim needs the money for something important. 2, Tim knows the full cost. 3, Tim has a clear plan to pay it back fast. If one of those is missing, Tim should stop. Not pause, complete stop, because this is how people fall into debt. They borrow a little, then they pay a fee, then interest grows. Then they make the minimum payment, then the balance stays. Then they borrow again. It's a vicious cycle. Now the card is not helping. The card is controlling them. And that is the part people do not talk about. Credit cards are tools. A tool can help you. A tool can also hurt you. It just depends how you use it. Anyways, guys, I hope you guys learned something from this video. I hope you guys enjoyed the video as well. If so, please remember to leave a like, subscribe to the channel if you haven't subscribed already, and YouTube thinks you'll enjoy this video next.